There's a tax rule that hits people at the worst possible moment of their lives, and almost no one warns them it's coming. Financial planners call it the widow's penalty. Here's the short version. Your spouse dies, your income barely changes, and your tax bill goes up. Not because you did anything wrong, because of how the filing rules are built. Today, I'll show you exactly where the penalty comes from, using the 2026 numbers, and more importantly, what couples can do about it ahead of time. This is general education, not personal advice. And every figure comes from the IRS and Social Security's published numbers. Start with what doesn't change much: income. When one spouse dies, the survivor typically keeps the larger of the two Social Security checks, keeps the pension or a big share of it, and keeps all the IRAs. Often the household income drops a little, maybe a quarter, sometimes less. Now look at what does change. Everything the tax code measures you against. First, the standard deduction gets cut roughly in half. A married couple filing jointly gets $32,200 in 2026. A single filer gets $16,100. On top of that, the over 65 additions change too. A married couple gets an extra $1,650 for each spouse over 65. A single person over 65 gets $2,050. And the new senior bonus deduction, the one worth up to $6,000 per person from 2025 through 2028, a couple where both spouses are 65 or older can claim up to $12,000. A widow or widower can claim $6,000, and it starts phasing out at $75,000 of income for a single filer, exactly half the couple's $150,000 line. Add it up for a couple where both are over 65 and qualify for everything. Roughly $47,500 of income, completely shielded from tax. The surviving spouse alone, about $24,150. Nearly half the shield gone. Second, the tax brackets themselves narrow. The income lines where higher rates kick in for a single filer sit at roughly half the married levels. So the same dollars that used to be taxed in a low bracket now reach into higher brackets sooner. Same income, higher rates on more of it. Third, and this one connects to our first video, Medicare premiums. The IRMA surcharge cliffs for a single filer start at $109,000, half the married number of $218,000. A surviving spouse with a decent pension, one large Social Security check, and required withdrawals from the combined IRAs can cross that line without changing a single spending habit. One letter from Social Security later, and the Medicare premium jumps. So that's the penalty. Half the deductions, narrower brackets, and premium cliffs at half the height, all landing on a person whose income mostly stayed put. Now the part that matters. What you can actually do, and when. The first thing to know is the grace period. In the year your spouse passes, you can still file jointly one last time. That final joint return is a planning opportunity, and it deserves professional attention because it's the last year the wide brackets and the full deductions apply. The second move happens earlier, and it's the big one. Remember last video's golden window? Roth conversions while both spouses are alive do double duty here. Money converted to Roth during the married years gets taxed at the wide married brackets. Whatever stays in traditional IRAs will eventually be withdrawn by the survivor at single rates. Every dollar a couple converts together is a dollar the widow never has to pull out at the worst rate. For married couples, this is honestly one of the strongest reasons the conversion window exists. Third, check the beneficiary and account setup while you can. Which spouse's Social Security check is larger matters, because the survivor keeps the larger one. Delaying the higher earner's claim raises the survivor's check for life. That single decision, made years earlier, can do more for a widow's finances than anything done after the fact. And fourth, if a spouse has already passed and your income has dropped, remember Form SSA 44 from our IRMA video. Death of a spouse is a qualifying life-changing event. If the income that Social Security is using is 2 years old and no longer reflects your life, that one-page form can bring your Medicare premium down now instead of 2 years from now. One honest caution in the other direction. Don't let the tax tail wag the dog. Decisions about claiming, converting, and withdrawing involve more than this one penalty. And a move that helps taxes can hurt something else. This is a conversation to have with a professional, together, while both of you are healthy. That's the whole point. Every tool here works best years before it's needed. 1-minute recap. When a spouse dies, the survivor files single. The standard deduction shield drops from about $47,500 to about $24,150 for an over 65 couple with the senior bonus. The brackets narrow, and the Medicare premium cliffs cut in half to $109,000. The defense is in order. Use the final joint filing year wisely. Convert to Roth during the married years at the wide brackets. Let the higher earners' Social Security grow because the survivor keeps the bigger check. And use Form SSA 44 if it's already happened and your income dropped. Next video, we stay on this subject from the other side. Social Security survivor benefits. What the surviving spouse actually receives, the age rules, and the remarriage rule that surprises everyone. I'll see you there.